All right, we're about to go way off the beaten path today. Forget your savings account, forget safe government bonds. We are diving headfirst into the high stakes, high risk world of investing in the debt of countries that are right on the edge of financial collapse. And we're going to explore what that long, messy journey back to health actually looks like.
This quote, this is everything. I mean, think about it. While most of us are happy to get a safe, predictable return, there's a whole other universe of investors out there. These are the people who run towards the fire, not away from it. They're hunting for absolutely massive returns in places most people wouldn't even dare to look. This is a totally different game with totally different rules.
So, to really get our heads around this, we're going to break it down into four key parts. First, we'll get into the mindset you need to even think about these kinds of investments. Then, we'll look at the story of how a country actually goes broke. After that, we'll get into the really technical stuff, how they fix the mess. And finally, we'll pull back the curtain and see who's really playing and winning in this arena.
So let's start with part one, the contrarian's bargain. This is the whole philosophy behind it all. It's not just buy low, sell high. It's about finding real, tangible value where everybody else just sees chaos and disaster.
You know, you can really split investors into two camps. On one side, you've got the defensive investor. They want safety, they want predictability, and that's totally fine. But on the other side, you have the enterprising investor. This person isn't scared of complexity. They actively seek it out. They use their intelligence, their skill, to hunt for those once-in-a-lifetime opportunities. And that's exactly the mindset you need for what we're talking about today. So here's the secret sauce. You don't find amazing bargains on things that are popular and that everyone loves. No way. The real deals are found in things that look, well, broken. The whole strategy is to find a situation where the headlines are so bad, where everyone is so convinced it's a total disaster, that the price just completely disconnects from any potential future reality. And that gap, right there, that's where the profit is. Okay, so that's the philosophy. But let's get practical. How does a country even get into a situation where its debt becomes one of these broken assets? We need to look at the anatomy of a national default. And look, this isn't just some abstract economic theory. This is a real, painful story that just happened. Take Sri Lanka in 2022. The cost to borrow money was already going up around the world. Then, the U.S. Federal Reserve starts hiking interest rates to fight its own inflation, and that sets off a massive domino effect. For a country like Sri Lanka, which was already buried in debt, that was the last straw. They missed one single interest payment, and the whole house of cards came tumbling down. The human cost was immense, shortages of food, medicine, you name it. And you can see that chain reaction right here. A decision made in Washington, D.C., a small 0.25% rate hike, ends up having these huge, catastrophic consequences for a country thousands of miles away. See, when the U.S. dollar gets more expensive, the debt burden for any nation that borrowed in dollars can become absolutely crushing, almost overnight. So what's one of the big red flags that analysts are always watching for? It's this number right here, the debt to GDP ratio. The easiest way to think about it is like your own personal finances. Your GDP is like your annual salary. Your debt is like your total credit card bill. If that bill is way, way bigger than your yearly income, you're in trouble. It's the same for a country. A high ratio is a flashing warning light that its economy just isn't powerful enough to handle its payments. Okay, so a country has defaulted. It's happened. The bonds have cratered. They're trading for pennies on the dollar. This is the moment of what we call maximum pessimism. But what happens next? Well, this brings us to the really technical, really fascinating part of this whole story, the Great Restructuring. You know, when a country is in a massive debt hole like this, there are really only four ways to get out. It's a process called deleveraging. First, there's austerity. Everybody has to cut back spending. Second, the debts themselves have to be cut down through defaults and these restructurings we're about to dive into. Third, you'll see wealth get moved around, usually through higher taxes. And fourth, the last resort, the central bank just prints more money. Every single recovery in modern history has used some painful combination of these four things. So let's zoom in on that second one, because it's the most important for an investor. A debt restructuring is basically a huge negotiation where the country tells its lenders, look, we can't pay you what we promised. Usually, this ends in what's called a haircut, where the bondholders just agree to take less than they were originally owed. But for the pros, it's not just about the haircut. The key metric they focus on is the haircut to recovery ratio. It's about measuring the loss you take now against the value of the new bonds you get in the deal. That number, that ratio, is what determines whether this whole painful process actually turns a profit. Now, you might be asking, why on earth would anyone agree to take a loss? Well, this quote just says it all. It's a really brutal calculation. Do you hold out for 100% of something you're never, ever going to get? Or do you agree to take, say, 40% of something that you will get? And this is where it gets sophisticated. Lenders often get new bonds, sometimes called transition bonds, which are part of a bigger recovery plan, often with backing from the IMF. They represent that little of something that has the potential to grow as a country gets back on its feet.
And all this complexity, the haircuts, the recovery ratios, the transition bonds, it should all be pointing to one unavoidable conclusion. To navigate this world, you need a lot more than just a regular brokerage account. This is truly a playground for giants.
And before we even talk about who these giants are, let's be crystal clear about the risk. I mean, history is just littered with examples of investors getting wiped out. Look at this data from the 60s. Cuban bonds trading for 20 cents on the dollar. Belgian Congo for 36 cents. Polish bonds, some as low as 7 cents on the dollar. A catastrophic loss isn't just some remote possibility. It's a very real part of this game's history. Here's the scariest part for a small individual investor. When a company you own stock in goes bankrupt, there's a court process, there are rules, but when a country defaults, you as an individual bondholder have basically zero power. You can't sue a sovereign nation to get your money back. There's no legal recourse. You're completely at their mercy. And that power vacuum is exactly why this is an institutional game. The big players, sometimes they're called vulture funds, they're not individuals. They are huge funds with armies of lawyers. They have direct phone lines to finance ministers and officials at the IMF. They get a seat at the negotiating table and can actually influence the terms of the deal. They can even use things like the World Bank's 2026 guarantee frameworks to make their new bonds less risky. And most importantly, they have the capital to just sit and wait for years without getting a single payment. They can outlast the pain in a way that no normal person ever could. And this number right here is the brutal truth. It's the biggest trap of all. An estimated 90% of retail investors who try their hand at this, they jump in way too early. They see the first big price drop and think, this is it, this is the bottom. But they're wrong. They get completely wiped out by that formal haircut we talked about. They don't understand that these recoveries follow what's called a J-curve. It's a sharp drop, then a flat line at the bottom during all the messy negotiations, and then a sharp recovery after the new deal is made. They buy on the way down while the institutions wait patiently to buy into the recovery on the way up. So we have to end with this question. After seeing the process, the players, the insane risks, where do you draw the line? The boundary between a brilliant, enterprising move and just pure, reckless folly is razor thin in this world. It takes incredible skill, it takes deep pockets, and it takes nerves of steel. So the real question isn't just about the potential reward, it's whether you're even equipped to play the game in the first place.